Rana Gupta of Manulife AMC is joining us today. Rana, good afternoon. Thank you so much for your time. Now, the popular opinion in the market is that 2022 actually could be the year of caution. You need to digest the gains made so far and tread carefully as far as the market goes on valuation, because taper and rising rates, all of that lie ahead, and the global liquidity will start going down overall. So emerging markets could come under pressure. What are your thoughts?
Good afternoon to you and your viewers. Firstly, I think there is some element of to that, because there are we had pretty decent gains for the entire last year, and our starting point is also that growth is moderating a bit, inflation is high, so the central bankers globally will follow a tighter bias monetary policy. Having said that, our view is that as we progress throughout the year, probably in the second half of the year, we see inflation peaking out and moderating quite a bit from the current levels. And we think the growth issues that we are facing, those will be behind us, so growth will pick up again. So as a result, we do think the second half of the year will be much better for the in general growth and the risk assets. And even in the first half, when the rates are expected to rise, we believe that the real rates will remain negative. So overall, the outlook remains constructive. In terms of returns, may not be as strong as last year, but overall, we would still expect healthy returns ahead.
Mm-hmm. Right. Rana, where does Indian market valuation stack up in the overall emerging market pack? Because if indeed the real rate of interest in developed markets could become negative, it may bode well for emerging markets. So if flows look this side, how do we compare on valuations front?
So I think real rates are negative. Maybe they will become less negative. So, but nonetheless, I think real rates being negative is by and large constructive for emerging markets. Now, within emerging markets, we expect that there will be certain divergences in terms of returns. That could happen because of the emerging markets' their own characteristics. What can happen is that within emerging markets, when the nominal rates are rising, you're most likely to see the emerging markets which has better fiscal health, better current account health, better inflation numbers, and also better or the lower foreign debt will tend to outperform. And if you now think about India on all these parameters, thankfully the fiscal is improving because of better tax collection, which is a result of better digital economy expanding. The current account is looking in better shape because of better export numbers and lower import numbers. The productivity is up. I mean, inflation at still below RBI expected, although the crude has gone where it has gone. And India has less amount of foreign debt. So I think put all these numbers together, I think within emerging markets, India's macro outlook looks quite good. Now coming to the question asked on valuation, obviously these factors we are discussing are, people are looking at it, and that is where the valuation has inched up a bit. Having said that, when you decipher the valuation, most of the re-rating has happened into basically the consumer discretionary stocks and the IT stocks. Beyond that, if you look at the domestic cyclicals, where we are quite optimistic because of the factors just mentioned, something like banks and the capital goods, real estate, I think that the valuation is pretty much in line with the long-term average. So there one can participate in good earning growth. And once that comes through, we believe some amount of multiple re-rating is also possible.
Let's talk about one of the big domestic cyclicals, which is the private banks, large corporate private banks. They have been under the weather for almost 1.5 years. Last 2-3 quarters, the numbers have started to improve. Do you see a fair case for investment in that area, given the way numbers have started coming now and the commentary coming in versus the valuation they are trading at? The likes of Axis, ICICI, that variety, just for example's sake.
Sure. I won't be able to comment on any specific bank names, but overall, the private sector banks that as a pack looks quite interesting to us. Yes, it is true that they have not performed as well as even we did expect. In fact, it turned out that FIs were sellers of those names. But it is those factors, right? I mean, before we even get to the fundamentals, I think the ownership of those private banks have come down. And if someone were to take a fresh look at 2022, I think this under ownership, given the stronger fundamentals, should be seen as a positive factor. Now, what are those fundamental things that we are looking at? See, basically, because of the factors which we just mentioned right now, the fiscal deficit is under control, current account deficit is under control. So the deficits under control means savings is higher. Now, when savings is higher, you've got to play the saving institutions like banks. That's number one. Number two, we think the corporate household balance sheets look quite all right, and they are ready to do capex in terms of households buying real estate and corporates putting in more capacities on the ground. And when that happens, the situation becomes quite ideal for credit growth to commence. So we do expect credit growth to pick up. When that happens, credit growth picks up, the top line picks up, the cost to income ratios fall, and core operating profit growth picks up. Moreover, the credit cost, we expect asset quality to remain stable to improving, which means credit cost would come down. So now think about all the things that drive the private bank's earnings, whether it is net interest margins, cost income ratios, or credit cost. All them will move in favor at a time that the valuations are not too expensive. Having said that, I would say that this credit cost decline is largely expected, and that is factored into the numbers. But we do believe that if in our view, there is some upside surprises that could come from core operating profit growth, which should be led by credit growth. So even within the private sector banks, we would back the banks which we think or which we believe will grow that top line faster than the others.
Right. Rana, what about the other domestic cyclical which seem to be coming out of several years of bear market, which is the auto space? Tata Motors was the only loved stock in that space due to very tangible EV-related measures taken, like the latest transaction. But everything else was not even touched by a barge pole. But today, over the weekend, some news flow seemed to be coming, but there's a move in unison. Do you think auto is also looking attractive now, given the way valuations have been crunched and ownership came down, or there is a case to look in that space?
So true, from the question that the way you put it from macro perspective, I think it's true. The auto space looks like good for a pickup, and the valuations are not that demanding, barring some bottom-up cases. So answer to this is yes. But once we dig a little deeper, we also have to be mindful about that the sector might pick up, but which are the companies that will benefit? Which are the parts? Which are the subcomponents or subsectors that will benefit? So, for example, even when the auto demand is picking up, we are seeing within the two-wheelers, the electric vehicles doing much better than the traditional two-wheelers. Within the passenger vehicles, when the demand picks up, we are seeing that utility vehicles are doing much better than the sedans. And there is a large unlisted market in India which sells automobiles, so we cannot play them directly. And this sector is also undergoing certain amount of disruption through technology changes and whatnot. So one has to be more selective in picking stocks. We would back the companies that have invested into the upcoming technologies, and also we would be comfortable betting on some of the auto ancillaries where you do not have any brand model, or rather you have less of brand model specific risks. A well diversified auto ancillary company could be the way to play the auto sector rather than just buying one of those OEMs, because in that case you do take some company model specific risks in the time when disruption is rife.
Right. All right, Rana, we'll let you go on that one. Thank you so much for your time and your inputs on the way you are analyzing the investing environment here.